Good morning. It's the top of the hour. It's 8 o'clock. My name is Dave Weiner on the Daily Call. We'll be getting started here in just a second. So, as we're getting started here, I want to talk about the different types of money that we come across and the real steps to go out there and do a more than an amazing job, a great job. It's very important that when you're out there in the field, not chasing dollars. I love 401k money, 403b money. I love existing life insurance plans. We do not replace dollars, premium, base amount, whatever you want to call it, for the sake of replacing. You have to put a person in a better position than where you left them. And it's all really about one thing, and it's about getting that person to save more money than where they've been at. How many people here have seen people, including yourselves and your households, try to save money? And for whatever reason, during the course of their lifetime, totally, absolutely failed at that endeavor. Now, what do I mean by that? Well, I'll give you an example. Let's say your household income is $80,000, husband and wife both making $40,000 a year, and you've done that for a decade. At the end of that 10 years, you've had $800,000 literally go through your hands. You made $80,000 a year. You went through 10 years. In that household, you had $800,000 go through. Now, the experts state you're supposed to put aside a minimum of 10%. That means that they should have, at the end of that decade, at least $80,000 tucked away. Since I use such a small income stream, how many households do you think I've interviewed that had lump sums of $80,000 in the last 4 weeks? And there's a lot of reasons why. It's easy to start saving money. It's a piece of cake. What we do is we attack it. We fall off. We start off at a young age. We're encouraged as kids to save money. Back then, we tucked away our allowance. Maybe we wanted something at the mall. Maybe you wanted to get, something special, some kind of toy or just something your parents weren't willing to do, but if you saved your allowance for a few weeks, you could have it. And I can tell you, as a kid, I had a deal in my household. I got allowance, and if I did the chore of cleaning up the kitchen every night, at the end of the day, now this wasn't like this was just throwing the last dishes in the dishwasher, whatever we had to do at the end of the day. But the bottom line was, I got paid an extra $5 a week back then. As a 13-year-old, it was something. I had a paper route. I was always consumed with, putting money together to do things. If I wanted a 10-speed bike, my parents weren't doing it, but that didn't mean I couldn't afford to do it if I saved the money myself. And it may have taken 8 weeks or 9 weeks. The problem was, as soon as I got what I wanted, I stopped. And I started again. And by the way, saving money is harder, more difficult for people than dieting. They both have their challenges. Have you ever met someone that started and stopped a diet before? Can you imagine? I might have known a person like that. What about exercising? Have you ever known anybody to go to the gym, stop going to the gym, go to the gym, stop going to the gym? Saving money is the hardest one of them all, because in society a lot of things changed. See, if you went back to the 70s, this was a long time ago, but back in the 70s, We believed in a buy now, pay for it now mentality. We were not a credit society. And in the mid-1970s, when they had the long gasoline lines and the energy crisis and all those little tiny things that were physically going on in the world, we stopped spending money, and our economy was no longer on the gold standard. And our country panicked because if we did not spend money on goods and services, then companies couldn't keep people employed. If people weren't employed, they couldn't pay taxes. It was a vicious cycle, and the government had to figure a way to get you to spend your money. And what did they do? They gave you tax incentives. Back then, they showed everything, and they began the world of payment write-offs. They let credit become a write-off. You could buy your wash machine for $15 a month, and you could write off the $15 a month off your income tax. You could write off your credit card interest back then. And we started becoming a society of payments. Now, a lot of people got in trouble with that. You know, it used to be if you went bankrupt back in the 70s, you were the scum of the earth. You were the pariah of pariahs. Nobody would talk to you. But when we put people on payment-itis, and we got people to start spending their entire paycheck, we started putting people into debt. And eventually, they had more payment than they had income coming in. And if you got more bills than income, that kind of kills the concept of saving money. Because the rule of thumb was you should always save first. Then pay your bills. Then enjoy what's left over. We became a world of enjoy, bills, then save. There was no immediate gratification for saving, and basically the bottom line is we as a nation, we went through major issues. And all of a sudden, the country's woes, which went into almost a full-blown depression by the end of the 70s, we had to lend money to Chrysler to keep them open. We were in disaster condition. Inflation was running away. We had inflation. We had double-digit inflation. If you borrowed money in the early 80s, you were looking at mortgages that were 14%, car notes that could have been as high as 18%. And what if those days ever came back again? And let's not say never, because anything is humanly possible. But having rapid runaway inflation, that wasn't fun, was it, if you were around then? And then this guy came into office, this Ronald Reagan guy. And he said, we have got to lower our taxes. We've got to raise money to put people to work. We've got to lower those taxes. And they had some good ideas. And they started lowering taxes because you got to understand the highest marginal tax rate in this country was between 60 and 70% in the 70s. And we went to a flat tax rate, basically around 28%. What was the catch? We had to give up all the loopholes. It's no longer writing off the interest on our cars that we bought. Have the write-offs and let Uncle Sam pay for part of our car. We were still hooked on it. We were hooked on payments. We weren't going back. We were never going to get back to a pay-now society. And that's sad. You see, that right there, this is 3 decades ago. But things kept changing. In 1974, the law called ERISA was passed. It was the Employee Retirement Income Security Act. It was a law to protect the American worker and their pensions, to make sure there was penalties if a company stole the pension money. But there was an obscure couple of paragraphs in there that said you could also now own and control your own maximum benefit supplemental savings plan on a tax-deferred basis. It was the birth of the and a couple of years later, the 401k was created, and the 403b was created. And all these things started being made and created, encouraging you, when a country was in massive debt, to save money on a pre-tax basis. Pre-tax, mind you. Why? Do you think that they're smart people in Washington, D.C.? Do you think they have intelligence? Do you think they got think tanks for the think tanks? Because I think they do. I think they looked back in 1970, 68, 69, at the end of the baby boomer era, right into our next group of people, and they realized two major things happened in this country. One was Roe versus Wade. All of a sudden, we weren't making enough babies. We weren't. We were using all kinds of, different things of birth control and abortions, and not enough babies were being made. I never buy into a politician who tells me he's pro-life. I buy into all the time pro-life and all things when it's religion. But a politician, I think they're just upset there's not enough taxpayers being born. That's what I think. But there were not enough of them. And also you had a thing called the Vietnam War that unfortunately killed a lot of our young people. We didn't have enough people. They knew this, and by 1974, they knew within 3 decades they're in disaster shape. They knew within 3 decades there would not be enough people paying taxes to pay the bills. So where was the revenue going to come from? Where was the revenue going to come from in the future? All of a sudden, the government has got a deficit. It was not a bad deficit back then. It was only like $1 trillion or something like that. Not the 17 disaster we got now. It wasn't that big a deal. But they thought ahead. They said, what if we could get Americans to save money on a tax-deferred basis and pay the taxes later? Oh my God, this sounds great. In other words, if you put away, a substantial amount of money and you're in a 30% tax bracket, it was the golden goose. And guess what, folks? It wasn't a golden goose. But everyone in my profession, the banking profession and the investment profession, we thought tax deferred was greater than sliced bread. And we were told, God knows who told us this, but we were told, and I was told this, we would probably be in a lower tax bracket when we retired. That was the biggest bunch of BS ever sold down the American people. In a lower tax bracket? How is that possible? But even at that point, most Americans still had a pension. Somewhere in the 1980s, as the 401k became popular, companies did away with the American dream, work 20 or 30 years and have a guaranteed income when you got to retirement time. The burden shift to you. And no one, and I mean no one, took the time to make you understand that. Companies would have to put away thousands per month to replenish your income, but they never shared that secret. Here you were going to your job, making your $4,000 a month or making your $3,500 a month or $5,000 a month, fully aware that to replace $35,000 a year would take about $1,500 in inflation and taxes. They never told you that. And you never, ever, ever could have afforded it. So I tell you, they destroyed you. They crippled you with their decisions in the 1980s. And no one saw it coming. You'd hear people starting to build balances. All of a sudden, they're building their nest egg during the 1990s, of all places, the stock market. Now, I'm not here to knock the stock market. I talk to people every day. But you give me a 55, 60-year-old or 65-year-old, could they afford the ups and downs? Could they afford the vitality of that marketplace? Come on now. There was a point in the 1990s, everybody figured prosperity was a given in this country. Have no clue why we thought that. You got to remember, when the shoe shine guy's giving you stock tips, watch out. The market kept going up and up and up. I used to go on homes with fixed interest rates around 10%. It could not go backwards. And clients would go, well, I'm making 25%. Why would I do that 10? How do you argue with that logic? I was just an insurance agent back then. But the markets did come tumbling down. And balances did get beat up. We will never, ever, 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 ever again see a bull market like that. Ever again, the rest of our life, to that degree. And someone could say, well, Dave, what about the last 4 or 5 years? Not the same thing. You started with $100,000 in 1999, and by the time you got to 2014, you're only sitting at $150,000. I don't call that a successful season. I call that a 4.22% rate of return for 15 years. If you used indexing, where you eliminated the losses, you saw our calculators, we came in at a net 12.75 for the same, mind you, 15 years. We have to change the way people save money. Last night I was in a conversation. I'm working on a monster case. You guys saw some of the preliminaries, and he's heavily in the stock market, mind you. And he goes, "You're going to tell me to put my money in life insurance? Are you kidding me?" And that's the way that is the perception of most people. You call it life insurance, they think it's an expense. They think it's a cost item. They cannot fathom it as an asset. Banks view insurance as the ultra-wealthy view it as an asset. Now, a lot of you were not here many, many months ago when I've done this before, but I want to tell you a story. Does anyone here remember the old commercials from the late 1970s when there'd be a bunch of people inside a restaurant? And then all of a sudden someone would say, "My broker is E.F. Hutton." And the entire place would go silent. You could hear a pin drop. When E.F. Hutton talks, people listen. Does anybody remember those commercials? Not that long ago. Folks, E.F. Hutton saw the tax advantages of life insurance in the late 70s. They fell in love with it. They go, "This is insane. You can grow money. You can spend it. You can pass it on. No income tax. Are you kidding me? The only thing they didn't like was the rate of return. They didn't like the rate of return. 1 to 3% in a world where CDs were going for 15%. All the tax advantages of the world didn't make sense. A 15% CD, even if you lost 2/3 of it back to tax, was still 5. It was still better than life insurance. So what did E.F. Hutton do? They bought a life insurance company, and they built the first universal life chassis. They had fees for their profit. And by the way, there were no rules back then. It was the Wild West. They did not approach normal people that normally bought life insurance. They approached real investors of money under management to put their money in a life insurance contract. Balances were being moved from 500,000 to 750,000. Big numbers. Imagine you put 750 in there and you were getting 15% rate of return on your investments. All of a sudden, $100,000 in capital gains or interest income wasn't on your income tax. It disappeared. It wasn't on your tax report. Do you think the Treasury Department noticed a missing $100,000 from one year to the next? Of course they did. And every one of these people were audited because this was a substantial amount of money disappearing off of tax-paying planes in 1977-78. And guess what? Treasury agents sat down and said, you know, last year you had $100,000 of investment income or interest income. This year on your return, it's not there. Was there an error? Did you forget the? There's no losses on your return. Where is the assets that used to produce those income? Interest rates haven't gone down. Investments are still doing good. Where's the money? Oh, my advisor, E.F. Hutton, told me to put my money into an insurance policy. And I was told I had a tax-deferred basis. I checked with my tax advisor. I didn't have to report my income. My interest income is taxable income. Okay, let me see that contract. And when the Treasury agent looked at these policies, they were flabbergasted, livid. They thought that this consumer was trying to cheat the government out of tax revenue. Why? They had people that put $500,000 into a contract where call the face was only $22,000. Who spends $500,000 for $20,000 of life insurance? Yes, the federal government sued every client for tax evasion and E.F. Hutton as an accomplice. Now, in the court cases of the early 1980s, every one of those people were exonerated. The government lost the battle. They did not lose the war. What happened? They changed the tax code. You learned the code numbers, the 7702 and the different tax codes. They went through three different tax codes until we got to the final definition of life insurance. We went through DEFRA and TEFRA and finally TAMRA. You went through the Deficit Equity Fiscal Responsibility Act. You went through the tax TEFRA, the tax exempt. I can't remember how to pronounce it. Doesn't matter. You went through DEFRA, TEFRA, and the last one was TAMRA. The twins, the evil twins, as they called them. In legalese, I'll put it in simple speak. Two things changed. Number one, the death benefit had to be bigger than the cash going in. No more $500,000 for $20,000. The second thing was called the pay test. You took this on your insurance test. The pay test was curated. It was called a 7-pay test. With computers, you could get it done usually in 4 years and 1 day. Now, most insurance agents, most managers in the 80s and 90s and the millennium, they didn't want to sell it that way. They didn't want to stuff all the money in there in 5 years. It killed the compensation. It meant only basically 30 to 40% of the money going in was delivered a commission. I remember the first time I learned about max-funded index universal life, and I was married at that time, and I remember going home to my wife, and we just made $150,000. And I came home and said, I learned this great thing called max-funded, and I realized that day nothing in the world could beat it. And I looked at Eileen and I said, you know, I'm going to do this. And I'm going to be honest, if I don't sell any more than what I've been doing, if I sell the same amount of production, instead of making 150, we'd make about 50, maybe 60,000 this next year. And she goes, well, then why would you do that? And I said, as much as it pains me to say this, I know something now. People are buying my policies for cash accumulation. I have to do it the right way. Now, my income didn't go backwards. My income exploded the other way because I became part of that 5% that was willing to do it right, that understood it. We were the elite. Became a Today, when we're doing monthly purchase, we may design to put a lot more money in, have a lot more face amount, but eventually every case we design is to be filled to the brim with as much cash as we can stack in that thing. And when we do it right, 60 to 70% of that money is not a target premium, it's an excess, because you're doing the right thing. And when you do those right things, contracts have evolved. These are not the universal lives of the 1980s. I remember when MetLife jumped in the UL market, and the first $1,000 in the MetLife contract earned a guaranteed rate of 4%. And after you got the 4 done, that's when you got the, back then, the 11s or 12%. I represented companies like Continental Western Life, Interocean Life. Life was different back then. So we so did a great job of saving money. And the thing called VUL came out. Now, I didn't jump on the VUL bandwagon. I stayed in the fixed market. I never got my securities license. And then in the mid-1990s, Index Universal Life was born. That's VUL on steroids. If you absolutely understand it today, in today's world, that's variable universal life on steroids. No one should ever do a securities-related product if you have a chance to get the market gains without the risk, even in the life insurance industry. Then living benefits came along. Things change. Tax rules change. They haven't changed in the insurance industry. They have not changed in 3 decades. You've got the most proficient machine in the world to house money. And all you have to do on a daily basis is understand the steps to getting a client to understand. It's not important that you understand, because you do. It's your client that has to understand that process. So let's talk about that process. Well, how many people like red line, blue line? I like that. It's 3 minutes and 41 seconds. It's a short video. It shows them taking risk or no risk. Now, they may comprehend it, they may not, but it's a starting point. The second step is to open up the Saver calculator. You go through the calculator. It's an important step. And you walk through side A, And then you go through side B. Is the policy sold yet? Absolutely not. The next step from side A to side B is play the Ed Slott video. Have you read the book, The Power of Zero, by David McKnight? The foreword by Ed Slott? If you're ever going to move real money, it's a 79-page must-read. Every client should read that book, and it will scare the living daylights out of you. You should have copies of that book as part of your process. If you're going after big money, the person needs to be informed, because there's a page in there from the Congressional Budget Office. That's not Dave Weiner saying this. That's not Steve Angelo saying it. It's the Congressional Budget Office. And they say if you're in a 25% tax bracket, you can plan on being in a 64% tax bracket. It's coming from your government. It's in print. The former Comptroller General is a whole almost a whole chapter and stuff he says that scares the bejesus even out of me. The forward from Ed Slott's great. But the objective of the book, The Power of Zero, is how to get to a zero tax bracket. The biggest killer of people's future retirement income and their nest eggs is going to be taxes. If you want to get technical at that point I might play the Bloomberg video, part 1. It's 7 or 8 minutes. But why would I play it? Because it would scare the bejesus about the silent killer called fees. If you don't got enough issues with taxes, let's throw fees into the mix. The average household spends in their lifetime $155,000 of their nest egg. In some cases, as much as half of what they put away. And if I told you, I want you to save $300, $400, $500 a month on your job, and by the way, I'm going to eat half of it. It's not even going to end up in your pocket, but I'm going to take half away from you. How would you feel about that? Should you play the Weiner video? That's me. Yeah, I think you should. They need to understand that they can't just go get the same life insurance policy from their agent. They should know that there's a difference between the old plans and new plans, that you're different. You're not your traditional insurance agent. This is the new stuff. And out of 149 million policies that are in force on the books in the United States, folks, there were only 86,000 of those sold last year. They're still selling the old crap. If you look at Primerica, who just in California sells 5,000 policies a month, and they're selling crap. They're selling term life insurance that does not accelerate the death benefit at all. In fact, they are the epitome of the enemy if there ever was an enemy. Not only do they sell garbage, they're putting people in the stock market for their IRAs. Yeah, buy term and invest the difference and put it in a mutual fund. Let's not have any tax advantages. Let's tax them to the hilt and give them a product where the claims ratio is less, in lifetime is less than 2%. And why did this happen? Maybe it was a good idea in the 70s, early 80s because there weren't other options. But the reality is, Wall Street bought that company. Wall Street bought them in 1989 for $1 billion. Term life never becomes, on that chassis, a claim. Do you realize out of every millions of policies sold, less than 2% is money paid out of the coffers of a life insurance company? That is like the greatest business model road. Yeah, paid commission, substantial commission to bring that money to the company, and we take that money for 10, 15, 20 years and then pay nothing out. Wow, I want that model. Give me money for a false promise. Yes, if you died in that time frame, yes, we'd have to pay it out. But this isn't real because insurance companies know. They know the numbers. They know the stats. Last year in America, the average age of death was 74. For a female, was age 80. If you're alive at 65, according to the CDC, that is the Centers for Disease Control, you got 19.3 more years of shelf life. 84% of the population last year died. Heart attack, stroke, cancer. Average age of a claim to a health insurance company was 43 for critical illness. It includes those 3 illnesses. If the illness is stricken under the age of 65, 7 out of 10 live. Not die. Not die. If your household's financial plan is based on you being in a pine box to protect them, I'm sorry, didn't work. You're incapacitated, can't go to work, can't pay your bills, but it's okay. 43 is the average age of a claim. Guess what 44 age represents? According to Harvard Law, there's a study. Average age for 2/3 of our bankruptcies in this country, average age for 2/3 of the BKs in this country, because they are cascaded medical bankruptcies, and not because of a lack of health insurance. 78% had adequate health coverage. Wasn't health insurance that bankrupted them. Their paycheck stopped because they could not go to work and they were not dead. You should feel bad for not having that heart attack and lying in a bed. You should feel guilty for not having your heart stopped for a penalty that day. I'm joking, obviously. But you destroyed your family. And the insurance agents that know about this product, that don't sell it, you're an E&O claim waiting to happen. And for the agents that are not taught this, they are the enemy. The ones that sell Banner Life and Great American Life and Lincoln Life and all the term companies out there, they're a piece of junk. They hurt Americans. What are you going to do against it? When you're placed in that P&C office, so you're sitting down advertising, an insurance agent comes to you and says, I have $250,000 of that old garbage life insurance. What are you going to do? You are going to replace it. But Dave, it costs more. Of course it does. It doesn't have a 2% claims ratio. We're taking them up to a 60, 70% claims ratio. Of course it costs more. It's the right stuff. It makes a difference. And when you're talking about saving money, we've done the calculators. Folks, come on. We take them through that. We take them through the Weiner video. This is the stuff you educate them on. Then what do? You take them into the illustration. This is like test driving a car. You're letting them drive it with their numbers, which means you need to know how to navigate the software. Because you want them to take the test drive. But you're not done yet. It's time to sink their mind to reality of what they were doing was wrong. Listen to this question. If what you felt to be the truth turned out not to be true, when would you want to know the truth? 30 years from now when it's too late? 10 years from now when it's too late? I think you'd want to know the truth today. You extrapolate the numbers out of that illustration, but we're not done yet. Before you run the 401k thing, you best cover the guarantees. It's important to cover the guarantees because your competition's going to cover the guarantees. They're going to look at your illustration, and they're going to look at the side on the left side of the ledger. And I have yet to meet an insurance agent that can sell and explain the left side very effectively. There's a lot of zeros on that left side. Can you explain it? There are two things that cause those zeros. And guess what? One, you cannot control. But neither can the insurance company. The other, you can control. You can negate the insurance company's control to increase cost in a life insurance contract. This is important stuff to convey to your client, so when the naysayers attack your illustration because they're trying to find some way to stop you because you are deadly, it's important to go through guarantees on an illustration, to point the zeros out and explain how the zeros happen. The question is, you ask the client, what do you get when the market goes down? How much is credited to you? Do you get a loss? Who knows the answer to that? When the market is flat or goes down, what do you get? You get a zero. It's okay. Unfortunately, if you get a lot of zeros, like 15 years or 20 years or 25 years, guess what? The money runs out. Because all you had was insurance cost and expense against your cash value, and it kills the policy. There was no profits. We're assuming never, ever, ever will the market ever be up again. We know that's hogwash. In the last 15 years, there were 4 bad years. We're destroying our competition, 12.75 to 4.22, but I have to show on my illustration a zero return forever, as if the market never returned anything. Now, I don't believe that's going to happen, but because it could happen, even a smidgen chance, I have to demonstrate it. And if we have a zero return for 15, 20, 25 years, every other device for saving money had a zero return. It doesn't matter where the money was. It was crushed, crippled, and thrown away. Because the fees would have ate up their money on the other side if there was no return. They're still out of money in the same time, folks. You can demonstrate that. What's the second thing? The cost of insurance. Insurance companies can raise the cost of insurance at any time they want. In that left side of the ledger, we show the guaranteed cost of life insurance. Now, there's been a few companies that have raised the cost of insurance in the last 3 decades. They have. I think 2 or 3 companies in 30 years have raised the cost of insurance. Under old management, F&G was one of those 3 companies. Now, they're not the same owners anymore. But that was one of the 3 companies that raised its cost of insurance. It does happen. It's a gotcha, unless you know how to deal with it. And guess what? We do. You see, they can't raise the cost of insurance against one individual. They raise the cost of insurance to the entire block of policyholders. Let's say you got a letter that says they're raising the cost of insurance by 10%. And you're having $400 a month taken out of your checking account. And the next month, even though you got that letter, only $400 came out of your checking account again. You would say, oh, man, they forgot to raise the cost. Sucker. You said you were raising my cost, but you only took $400. No, sir, not true. It was an internal raise, and it's like a cancer. If you don't deal with it, those cancer cells are going to eat up all of your money. How do you negate it? It's simple. They raised the cost of insurance 10%. I lower my face amount by 10%. I effectively negated the increase in cost. My projections stand hold. I'm not destroying my internals. Or if I feel I need that face amount, I increase by the amount of the increase in mortality cost. This is why you must do reviews every year. The last piece of the puzzle, the last piece, is the 401k fee calculator. That's where you show them, in their current scenario, running out of money, and us, in our projected side, going to age 120. You've educated, and you took them to the finish line, and now it's time to write the app. I prefer e-app. You put the app inside the system. If you need a medical, you order the medical. You tell them the medical person is going to be coming to see them in a day or so. You let them know. They sign, they apply their e-signature. Now what's next? You put everything away and you have a heart-to-heart with them. Because your closing line that you used to close the case after all that education was same or more. Do you want to save the same amount of money you're doing, or do you want to do more? Oh man, my budget. Well, let's just right now. Let's just keep it the same right now. All right, write the case, order the medical, and then let's talk. Let's talk about the reality. You're not saving enough. You know it. I know it. Share the business opportunity. Now, you can go back to your VPI. We have a video for sharing the business opportunity. Or you can do like I do. Make it really simple, little conversation like I've done. I just share really quickly. You've got a couple hundred contacts on your phone. I don't mind getting the referrals, but you need to be in business. We put people in business, and one of the businesses we can put them into is the insurance industry. And as a rep, if you help someone save $100 a week on our entry-level contract at 40%, guess what? That's a paycheck for $1,440 a week. That's almost $6,000 a month of actual cash flow. The reality is they don't have the knowledge. They're going to have somebody come to the plate. They're going to have to hire someone. They're going to have to hire a Vermin Brown or a Tony Padilla or a Steve Angelo. They're going to have to hire you to go out with them, and they're going to have to split that case. So they're only going to cash flow $735 or about $3,000 a month. Can't they tuck away half, $1,500 of it, and then add that to the $300 a month they're doing? Now they're saving $1,800 a month. Now they're making a dent into what they need. That's the miracle. That's what this is all about. We're going to open up for Q&A now, questions and answers and feedback on what you've seen here today. We're going to open the mic on some people here today because this is important stuff, and we've really got to get this right. So I'm going to go to, for starters, I'm going to go to James Medwin first. Not James Medwin, John Medwin. Sorry about that, John. John, good morning. How are you?
Hey, good morning, Dave.
Did this help you at all today?
Oh, it's great. Yeah, it's a great process. Very methodical, very powerful.
Most insurance agents don't do it this way, do they?
No, I don't think they have a method. And yeah, I like it. No sense reinventing the wheel. It's pretty powerful.
Is it too much history? Is it too much education? I don't think so.
No, people respond to it.
What about spending time on the guarantees? How important is that?
Oh, I think it's huge because people are going to, if you don't bring it up, they're going to always wonder about it. They're always going to doubt it. and somebody puts it in their mind, you're going to lose the case. So we have to talk.
Now, if you're trying to move a couple $100 a month, they might not question it. But if you're trying to move millions of dollars in one transaction, don't you think their past advisor might take a shot at you?
No, absolutely. You know they will.
They're going to go and say, well, looky here, it's a lapse, and then your contract's gone. This is dumb. What a waste of money. Unless that person understands how those zeros were derived and how to negate those zeros and how unrealistic those, they're on zeros where they're zeros too if the market does that. They don't have anything either place. They need to understand if we're zeroed here, they're zeroed there. That's the reality. We're in the same market. We're in the same world as they are. They're zero for 25 years. We were zero for 25 years. Their fees killed them. Our insurance costs killed us. They want to point out zeros. They need to understand they're zeroed out also. And that's important to understand. Next, I want to bring other people. I want to see how much we're retaining this. I'm going to go to Darren Delaney in Iowa. Darren, how are you this morning?
I'm good. How are you?
Darren, is this helping you at all this morning?
Yes, it is. And I just shot you a question. If you could read that quick. I'm going to be targeting realtors and loan officers and try to show them, how they can become their own banker and use, that cash that's accrued as down payments for investment properties. And can you explain how the loan provisions work in the cash value?
Absolutely. Now, we don't have enough time. That's a class in itself. But you know what? Tomorrow morning, Darren, we're going to talk about accessing the money from the policy, the good, the bad, and the ugly of it.
Oh,
how's
great.
That sound to you?
That's
and
good.
We'll spend about an hour on accessing. That's not a 5-minute question. That's about a 30 or 40-minute question. Just remind me before we start tomorrow, text me or whatever, just remind me we are going to do accessing the funds. There's a smart way to access them, a dumb way to access them, and a sad way to access them. And we're going to cover all three tomorrow.
Okay, because there's a niche there I want everybody to realize, and it's so easy to target those kind of people that all you got to do is get a nice little marketing campaign, whether it's postcards, whether it's a little flyer you go drop in the mailboxes, or whatever it is. You go after that niche group, and you become the guy that shows them how they can become their own banker with these kind of policies.
I'm going to tell you something for my real estate investors. My one product has a real estate edge. I've got a real estate index, and to be able to have all the gains of the real estate market with no cap and pay no taxes is a lot better than buying real estate and trying to make gains on it and sell it and all that stuff and collect rents. We've got a way to be in the real estate market without being in the real estate market, and that's a beautiful thing. So,
Great,
I want to open the mic. I want to open the mic here to Ben in Las Vegas. We're going to Las Vegas. Ben, your mic is open. Have I helped you?
Good morning, Dave.
Good morning, Ben. How are you?
Oh, I'm just fine, thank you.
Tell me what's going on in Las Vegas. What are we doing there? What's the game plan this week?
Well, the game plan this week, Dave, is to get some advertising going, and then we will follow the same game plan that you have, and I'm going to hire you initially, and then I'll learn from you.
That sounds good, sir, because you know I'm a poor Jewish person, and I don't like being poor. I'm being facetious, guys. Just kind of be funny here this morning. A little bit of sense of humor. Let's see here. We're going to go to. I'm going to go to Carlos Millsap down in San Diego. Carlos, you've been privy to a lot of this in the past, but is this helping you for your group right now at all today?
Absolutely. Can you hear me, Dave?
I can hear you. Tell me what you're going to take from this right here today. What are you going to do with all this knowledge this morning?
Well, the thing is that we have a lot of stuff here, a lot of information in order to help my team grow. One of the things that we're planning on doing, in fact, myself, Jeff.
Sorry about that noise. I'm gonna close that up there. But Carlos, You've always been one of the biggest builders. And I want to ask a question before I close you out. Are you going to be competitive for Minnesota in July 10th and 11th? What are you going to build for the month? You got two big dates. You've got March in San Diego, which I'm going to be helping you with. Now, I tell you something, folks. And what I'm going to do here, I'm going to fix this really quick here. Bear with me for 1 second, then I'm going to reopen Carlos's mic. Carlos, I want to know what we have to do to make sure we're the biggest entity at the March event in San Diego. And what are you doing? What are your goals for July in Minnesota so that we compete against Team Gillis?
Well, part of what's happening, Dave, is that myself, the judge, Herb, and Steve, we're actually coming together, and we're looking at following some of your model, but we're also looking at one of the things that we're looking at doing is one of the things I've been looking at this morning is doing a blitz, doing a campaign to where we're going to build big. We're going to be relentless. That's one of the things that me and Steve and I were talking about yesterday is just being relentless and just recruiting. Sometimes what
how many people do you think you have in Minnesota? Keeping in mind they've got 6,000 person head start, and even if they get 20% of their field force to that meeting, they're going to be. We're looking at 3,000 to 4,000 people there this summer. My question to you is, from you're part of our group, what can I count on you to build in the next 6 months for that event? Because this is a big deal to WA. I challenged that gentleman big time.
Right. Well, Dave, as far as the numbers concerned, my goal right now is I'm going to get 20 people in 30 days. And I plan on, repeating that cycle. And the other thing is I'm going to try to get those 20 people, as many of those as possible to get 20 people as well. So that math can be.
I'm going to show you something pretty awesome, and then we're going to close on this. I'm going to show you something amazing. If you cut that in half instead of going 20, if you just go 10 in 30 days, this is for everybody here. 10 in 30 days, but we place them in their location. This is important. I like brick and mortar, folks. I'm a big brick and mortar fan at PNC location. 10 in 30 days. Now this is all about dollars. An average of $300 a month, replacing their life insurance policies and 401k contributions in their home. That's $36,000. But that 10, getting their 10 in the next 30 days, you still got to do your $36,000 because you're going to get 10 more the next 30 days. But now your team is going to do their share. And here's the good news. 36,000 times 10 people, that's 360,000. That means your agency is now doing close to $100,000 a week, and it took us 60 days to get there. Now here's the good news. The next 30 days at 90, you're doing your 36,000. Your first group of 10, they're doing the 360,000 all over again. And guess what? Those 10 are getting their 10, and that is $3.6 million. That's how we fight. It's a 90-day game plan. And there's nobody here that anybody can, with this process, with advertising, understanding there's millions existing and comatose insurance people. There's 92 million people in the demographic of 45 to 60 years of age that are either unemployed, underemployed, or given up trying to be employed. They need a job. And more imperatively, they need hope and opportunity via a business. And this isn't a pie-in-the-sky business. This is not a multi-level marketing deal. This is a real career that I have been engaged in for 33 years, and I resent anybody that puts this industry down. This is a real job. I get up every morning and I go to work. I believe in what I do, and I know I make a difference. And we have 200,000 people exiting this career in the next 2 years because they're 70 age or plus. We have a job to do, folks. And we can do this because 10 in a month is reasonable. It's It's doable. I'm not going to tell you it's a piece of cake, but you can do it. 10. That's a magic number. That's 2+ a week. 7 days in a week, you got to get 10 done in a month. Now you do 10, yeah, you're giving off $3,600 of lifetime to your host. You think they love you? Of course they love you. Now they're sharing people with you. 10. 10 is the magic number. And what we have you at, folks, what we have you at in 60 days is that's $100,000 a week. Now, when you can wrap your hands around the fact that you're only putting 2 people a week on, and you're getting yourself to put 2 people a week on in that structure, and I look at a Steve Dago or I look at a Steven Adams or Rafael Perez, I am not asking the impossible of you. I'm asking you to work. That means you got a $5 million agency in 60 days. It means the steps happen, folks. The steps actually happen. And our process is really simple, and I'm going to close on the process. They attend the workshop that we do live every Tuesday. And I got a new one I did yesterday, and I think it was stellar. I think it's way better than the past recorded ones that we had. It was a good workshop yesterday. Then they go through the interview. The interview is for us to learn about them. I want to know what makes that person tick. I want to know why they quit that job. I want to know why they did this and did that. Also, I want to know how they're saving, how much they've had saved. Because I guarantee you their money is in the wrong place. I want to move that money. I want to find their life insurance they bought in the past. Why? Because I guarantee you it's not the right stuff. The odds of it being the right stuff is 1,000,000 to 1. Well, 149 million versus 86,000. There's a chance you might have it. You might have been one of those 86,000, but I doubt it. We don't replace for the sake of replacing. We do things because it makes sense. Carlos, John, Darren, everybody I asked to participate for a few seconds here at the end. This is our dream. That's why I call this program Dare to Dream Again. And we are absolutely making dreams come true. It's 9:03 in the morning, January 14th, 2015. Everyone have a great day. Thank you.